Hello, everyone, and welcome to the Ivy Investors channel. My name is Courtney Richardson. I am the founder of the Ivy Investor. And what I wanted to talk to you today, kind of happy new year, is to talk about two simple investing strategies that you can use in 2020. A lot of people come to me and ask me like, hey, really want to get started investing, really don't know where to start. And I'm like, you know what? I can give you guys an idea of some simple investment strategies to get you started. Now, I just want to let you know before we even talk about any companies, please know that it's up to you to do your own research for your own portfolio. You might want to talk to your tax advisor. You might want to talk to your financial advisor before engaging in any particular investment strategy. Wanted to get that out of the way. Anyway, so let's start. So the two strategies I want to talk about are dogs of the Dow and small dogs of the Dow. You're probably going, huh? So dogs of the Dow is basically it's kind of an offshoot of the Dow Jones Industrial Average. And just really simply, it's a stock picking strategy that focuses on the highest paying dividend stocks, 10 of the highest paying dividend stocks as of the previous year. And it was developed by Michael Higgins in his book, Beating the Dow. So it's a really, like, the Dow Jones is relatively straightforward. It's about 30 stocks. And you know what? A lot of people I take it for granted that people may know what the Dow is. So why don't we do this before we even have any more conversations? So here is the companies in the Dow Jones Industrial Average. So there are 30 stocks. Now, just as a way of background, the Dow Jones Industrial Average was started or kind of came up in 1896. So it's an old index, and an index is basically I don't want to call it a basket of stocks, but it's basically a listing of stocks that fit a certain criteria. So here, the Dow Jones Industrial Average used to be an industrial kind of index, basically trains and like industry, like factories. Now it's evolved since 1896 because, of course, the United States has evolved since 1896 into being more of kind of like pretty much everything, but pretty much household names that are more in line with what we think of the U.S. economy. So when we're looking at the quote market, they're usually talking about the Dow Jones because they're looking at the market, and this is what we consider to be a barometer or kind of like letting us know what's going on in the U.S. economy, just like in a snapshot. So there's companies like that we know on a regular basis, like Johnson & Johnson, JP Morgan, American Express, Apple, Microsoft. Really common companies, household names, Nike, but there's a couple that are not so well known. United Technologies is a company out of Connecticut, and it basically works in aircraft, aerospace engineering, heating and cooling. 10% of their revenues comes from government contracts. They're a large military contractor. So just kind of putting it in context, looking at what's going on in Iran, this company may be one of those types of companies that would do well in wartime. I don't know that for a fact. I haven't really done that much research on them. And again, always do your own research to see if there's opportunities that you could find. But you know what? Don't just kind of take my word for it. Do your own research. Anything that we talk about in this video is not a recommendation to buy or sell. So let's go. So basically, we have the Dow Jones Industrial Average, and then we kind of take a derivative of that. Like I said, it was the top 10 stocks that have the highest dividend yield. So let me clarify. So it's the top 10 companies or stocks with the highest dividend yield. I don't want to say the top 10 because a lot of people will get that top confused. So just the stocks with the highest dividend yield over the past year at one is actually really just as of December 31st. It may not be the entire year that it had the highest dividend yield, but as of December 31st, because you kind of want to have a point in time, as of December 31st, that's these stocks have the highest yield. And so, like I said, there are 30 stocks. And just as a way of background, the most recent the Dow Jones does not change that frequently. It changed earlier, I believe in 2019 or maybe 2018, when Dow became a component which replaced Dow DuPont. And Dow DuPont, if you don't know, actually did a split. So kind of they split into their own companies. Dow is on the Dow Jones and DuPont is not. But more recent than right before then, Walgreens replaced General Electric. So, I mean, it doesn't really, and that was in June of I think 2018. So this does not change that often. So I want to put that in perspective. These things don't change that often. And so it's a really big deal if a company is removed or added. And then, like I said, they're only going to be removed and added. So a company is going to replace another company. Let's see. So I believe, and just to remind myself, I think Apple replaced AT&T from the Dow, and that was a couple of years ago also. So just to kind of give you guys a background on the process of the dogs of the Dow. So the way it works is that if you're going to use this strategy, is that you invest an equal amount of money into each company at the beginning of the year, the first trading day. Of course, it's not going to be January 1st because January 1st is a holiday, no trading on that day. But you would do it on January 2nd or whatever the next trading day is, invest the equal amount of money. So for example, you would do, maybe you wanted to invest $10,000. So you invest $1,000 in each company. And you would basically hold them all year, and then you would basically see what goes on December 31st of the next year to see if a company needs to be removed and if a company needs to be removed, then another one be added. But remember, we're looking at a relatively small universe of stocks because it's only 30. So just as a side, or kind of like an additional thing, is that this is a strategy that's a long-term strategy. You're not looking to kind of get rich quick off of it. This is something that is an ongoing strategy if you decide to use it. But like I said, it's relatively simple because, it's only 30 stocks, and of these stocks, only 10 of them you're actually even looking at. So and just in terms of performance, this is from the Dogs of the Dow website. So I haven't personally run the numbers. Since 2000, the dogs have performed on average, or kind of, I should say, annual average total return of 10.4%. So that also includes dividend reinvestment. The small dogs, 12.7%. And so let me back up for a second. So the dogs of the Dow are the 10 highest dividend yielding stocks of the Dow as of December 31st, 2000, and this year would be 19. So the small dogs are, of that bunch or that bucket of 10 stocks, it's the cheapest stocks, the cheapest 5 stocks of that. And they're called the small dogs are the puppies of the Dow. So when I'm talking about the two of them, just kind of keep that in mind. I don't want you to get confused. And in a second, I will show you what those are. But so the dogs performed with dividend reinvestment 10.4% annually. That's their average annual total return since 2000. The small dogs have performed at 12.7%. Also average total return, which would have been dividend reinvestment. And then in comparison to the Dow Jones Industrial Average, so the index of the total 30 stocks, that's done on average total return 7.5% or 7.5%. And then the S&P 500 has returned almost about 6.5%, 6.4%. So as you can see from the kind of the turn of the century, the dogs of the Dow, the small dogs, have pretty much outperformed the kind of standard indexes, the S&P 500 and the Dow Jones Industrial Average, which most investors consider to be, quote, the market. So I think that's really interesting to tell people about, so they can kind of go, oh, okay, well, I kind of get what you're thinking or what you're saying. And that being said, I really try to keep people in the know, because I mean, it's something that you probably should know. And more importantly, it's something for people to say, oh, okay, I get it. There's something that I can at least start with. So what I want to do is give you guys the listing. And also, just as an FYI, so you guys know, I will put in the show notes the link to the investing in dividends class, because a lot of people are very interested in it. And I want people to be able to grab it and take advantage of it if you guys want to. And because I just love my YouTube peeps, I will give you just what I want to consider to be like a little bit of a discount. So, but I want to give you guys here is you have the dogs of the Dow. So like I said, these are the highest dividend yields as of December 31st, 2019, as you see. So you have Dow, which we talked about was kind of just recently added to the Dow, ExxonMobil, IBM, Verizon, Chevron, Pfizer, 3M, Walgreens, Cisco, and Coca-Cola. Those are your dogs of the Dow. So then when we look at the small dogs of the Dow, we look at price. We're looking at the cheapest of the 10 dogs to get the cheapest 5 of the 10 dogs. And we're calling those the small dogs or the puppies of the Dow. So you have Pfizer, you have Cisco, you have Dow, you have Coca-Cola, and you have Walgreens. So again, this is the opportunity. If you want to look into a strategy to get you started, you may want to consider looking at something like here, like the small dogs are the dogs of the Dow. Relatively simple process. Like I said, I shared it with you. And if you're more interested in dividends, you can always look at the show notes, get your coupon code to get the dividend investing class that I have available on Teachable. So if you guys don't have any questions, please let me know if you have questions. Put them in the comments. Always leave me a comment. Always feel free to subscribe. Always want you to subscribe. Please expect kind of videos probably about twice a week. And I look forward to catching up with you guys and seeing your comments. Have a good one.